the Cobalt Market Report, looking back now at 2024 and trying to understand all the different factors that play into this. So we're going to take a moment now to look at everything in that wider context. I'm very pleased to start to take us through this. Welcome the Head of Communications at the Cobalt Institute, ladies and gentlemen, Marina Demidova. Marina, thank you.
Hello everyone, and welcome to the opening session of the Cobalt Congress that traditionally launches the Cobalt Market Report. In the next 90 minutes, we'll be discussing all things Cobalt market, demand and supply trends, market outlook, and also external factors that will shape the market moving forward. This session launches the 2024 edition of the Cobalt Market Report, which is the most comprehensive and publicly available market overview. It gives unique insights on the global cobalt market trends and, since recently, factors in geopolitics too. I'm very pleased that the copies of the report will be available at the registration desk right after this session. And if you're interested, the report is now available on Reuters as well. The report has been produced by our colleagues at the Benchmark Mineral Intelligence, our information provider, for 3 consecutive years. And I'm delighted to introduce you to Will Talbot, who will share insights on what trends drove the market last year and what the industry should expect moving forward. We'll have a chance to speak to Will at a fireside chat after his presentation, and we'll invite other speakers on stage shortly after. I strongly encourage you to come up with questions which you'll be able to answer during the panel. Go ahead, Will. Over to you.
Thanks very much, Marina. And a huge thank you to Dinah and the rest of the Cobalt Institute for having us. My name is Will Talbot. I'm a research manager at Benchmark Mineral Intelligence, and as Marina said, it's been 3 consecutive years now that we have produced this annual market study for the CI. So I'm going to present a little bit today about our view for last year, before moving on to some expectations for this year and what we expect moving forwards. But before I get into that, perhaps I should just introduce Benchmark to those of you who are not aware. So Benchmark is the leading data provider for the energy transition. We provide research, market intelligence, strategic advisory work through consulting, as well as price discovery through our business. Also work on sustainability and our own conferences. Our price data is IOSCO certified. And we also acquired our sister company, Romotion, last year, which means that we're now able to offer full mine-to-grid coverage of the energy transition, all the way through to EVs, ESS, portables, etc., and up the supply chain through to mining. So I think if we look back at last year, I think the key story is just unprecedented low prices. We saw a huge glut of supply coming online. That pushed cobalt prices down to their lowest levels ever, both in nominal and in real terms. Effectively, this was primarily driven by overproduction from the DRC. You can see there the chart on the right-hand side, which shows production by country. There was also some growth from Indonesia, whereas other Western markets, particularly Australia, cut outputs. And really, this has been fueled primarily by CMOC. So CMOC ramped up its copper cobalt production at KFM and TFM as well last year. Most of the growth was in KFM. It produced 114 KT, a tremendous growth year on year. And this is, when I speak to people about this, a lot of people ask, what is the reasoning behind CMOC doing this? And I think if you look at the geology, part of the answer is there. KFM in particular has a very low copper-cobalt ratio. So that means that for every ton of copper that they mine, they bring online a significant amount of cobalt. So in the DRC, the average copper-cobalt ratio on a resources basis is about 10 to 1. So 10 tons of copper, 1 ton of cobalt. In KFM, it's more like 2.2, 2.3. So as they've targeted that copper production, at the same time, that has brought online this huge amount of cobalt. And the supply has been completely unprecedented. If you look at the stated capacity of those two assets in cobalt terms, the production last year was 30% over that. So really, it's a huge increase of output from that site that has been driving the oversupply that we saw last year. As a result, we had this weighing on prices. Metal dropped to sub $10. And actually, this pressured several other DRC players. So we saw, outside of CMOC and a few larger players, a lot of smaller producers actually ended up cutting cobalt output. Now, some of that was, that is because of that price response. And in fact, some producers shut their cobalt lines entirely. So we saw China Railway's MKM asset cut production. Earlier this year, MMG Kinsevere also cut cobalt production. Now, because of the way that cobalt is produced in the DRC, the circuit runs to produce copper cathode first, and then the hydroxide is, cobalt hydroxide is produced separately. So producers are still able to produce copper whilst not producing cobalt. And so because the low price environment has led the DRC producers to cut cobalt, they're still putting copper out to achieve revenue from there. Now, if you compare that to Indonesia, because that product is a mixed nickel cobalt hydroxide precipitate, actually Indonesia continued to ramp up output last year, primarily driven by the nickel market. So a lot of HPAL sites in Indonesia have continued to come online. They're increasing output. They're bringing nickel tonnage online, and similarly to the DRC, they're bringing on cobalt with it. But again, because that's a mixed product, that tonnage is bringing cobalt tons to the market as well. You can't just switch the cobalt line off. And for that reason, we see this huge growth from Indonesia, now the second largest producer, and equivalent to about the rest of the world combined. And another key trend I want to highlight has been the increasing sustainability accreditation that we've seen. I think Dinah mentioned earlier that Glencore achieved the copper mark earlier this year, joining CMOC. And actually, if we look across the different third-party assessments that are in place, actually there's a significant amount that is now assessed under at least one measure. So the copper mark is maybe one of the most well-known. Another one would be TSM. And TSM actually assesses refined cobalt, but because the assessment includes all steps in the value chain, you can infer that certain mines also meet the standards that it sets. So that bar on the left-hand side, you can see that well over 70% have been awarded the RMI. That standard effectively means that those mines are meeting that standard even if they're not explicitly assessed against RMI. And indeed, on a refined basis, which is the pie chart on the right, you can see that well over 80% of refined cobalt production now meets this environmental standards. And I think as Tom alluded to, ESG is not just a nice to have, it's increasingly important, not just for producers, but also for consumers. Automakers in the West, their purchasing teams now see that as in some cases, an absolute must-have, that they have to achieve certain sustainability standards in order to purchase material. And I think that's becoming really apparent for producers. Moving on to demand, and I think when we talk about the glut of supply that we saw last year, the low price environment, it's very easy to forget that actually demand is incredibly robust. Last year saw record cobalt demand of 200 KT across all market segments. The primary growth driver in terms of actual tonnage and in year-on-year growth was, of course, the EV market. Whilst we also see significant tonnage from portables and also from the superalloy sector. EVs really are now the key driver of demand. We've seen growth year-on-year of over 25 KT, 26.7 KT year-on-year, bringing demand up now to record levels. And despite what you may have heard in the media, EV demand really is robust. We're still seeing double-digit growth year-on-year. And if we look at different geographies, each of the top 10 EVs sold in the European Union and in the US last year used some kind of cobalt-containing chemistry, or had the option of having a cobalt-containing chemistry. And whilst China is the biggest market overall, and has indeed shifted towards cobalt-free chemistries, such as LFP, what we've... sorry, this is EV still. what we see on a regional basis is that actually in NCM terms, or megawatt-hour terms, China, the EU, and the US are actually very similar in terms of their total demand. China is a large market, which is primarily now LFP focused, but still has a sizable NCM minority, whereas Europe and North America are comparatively smaller markets that are much more dominated by these NCM chemistries. And so actually in total demand terms, or tonnage terms, megawatt-hour terms, those three regions have fairly similar demand growth. Now, when we move forwards, what we would expect is that, yes, LFP is gaining market share. It's probably going to top out at about 60%. But it really dominated in that Chinese market, and in the Western markets, particularly the US, we really see NCM as being here to stay. And that applies not just from EV sales, it's all the way through the pipeline. If you look at the Gigafactory pipeline, ex-China, the vast majority of those, and in particular the majority of those that have received the most funding, are NCM chemistries. So NCM is deeply embedded in these Western supply chains. It remains embedded in China, and it's not going away. It's going to remain a significant, sizable minority, and it's going to continue to drive cobalt demand moving forwards. Another thing which I know Seto touched on briefly has been technological innovation. Now, within the NCM space over the past few years, there was this trend of moving towards high nickel chemistries. The idea was that as you increase your nickel content, you get better quality, so longer driving range, better energy density. But of course, the reason we have cobalt in batteries is because it's a fire blanket. It stops those batteries from having thermal runaway whilst continuing to provide excellent performance. NCM batteries need cobalt, right? They need that in order to prevent these safety issues. And increasingly, we saw consumers are being worried about this too. And so several battery makers, particularly in South Korea, have actually pivoted back from high nickel chemistries back to mid-nickel chemistries. And they've effectively upped the voltage. So they've used a number of technical innovations, mainly using single crystal to do this. But the upshot is that these chemistries are now more cobalt-rich than the previous high nickel chemistries are, but they achieve the same technical specifications, or similar technical specifications. So actually, within that NCM space, not only is it growing, but it's now pivoting somewhat more back to a higher cobalt intensity. And I don't think we can talk about the cobalt market or indeed the critical minerals markets without thinking about geopolitics. We're increasingly seeing minerals as a whole being seen much more strategically, not just by the producing countries, but by the world superpowers, so the United States and China. We've seen critical minerals deals between the United States and the DRC. We've seen the US getting involved in Ukraine as well. Critical minerals aren't just a section of industry now. They're a key geopolitical tool, and that is a trend that is not going away either. And for cobalt, I think we see this not only in the sense that EVs are strategically important, and of course they are, but the non-EV uses of cobalt have particular defense applications, which several countries now see as being of vital strategic importance. When we look at military applications, we see superalloy use in jet engines and in some aero and cobalt magnets, which are used in actuators throughout aircraft, land vehicles, and indeed Navy vessels as well. On top of that, there's the increasing use of new technologies such as drones. That is a military application. It's also a civilian application. Those batteries, they will be using lithium-ion batteries. They will be cobalt-containing. And it's another key growth market that we see. But overall, despite this strong demand growth, the fact of the matter is that supply was greater than demand. We saw a surplus last year of around 36 KT, which is 15% of demand, so a huge output. And as a result, we saw a consequent drop in prices. This was actually probably more apparent for sulfate and hydroxide than it was for metal. These are our own assessed prices. And you can see that actually the trend year on year towards the end of 2024 was this significant downgrade in pricing. But as we entered into 2025, the DRC export ban has meant that we've seen a corresponding uptick. Now, we ran some scenario analysis on what we could potentially see next. I think moving forwards, there are a number of avenues that the DRC could take. If there were some kind of production and/or export quota, I think what that would show would be to quite immediately eat into that surplus of material. If output was set at 2023 levels, we would see a sharp correction, I think, in the balance. However, there would be a risk of demand destruction because demand growth continues apace, and there's a real risk that if that quota is set too low, yes, it would incur a price increase, but it would also potentially reduce demand in the long term because of demand destruction. Whereas a more limited approach, for example, by limiting output to capacity, would be one way of perhaps targeting specific assets that have gone well over production in the past year. And I kind of want to take a step back, actually, before talking a bit more about 2025, because we've obviously seen this huge spike in prices recently on the back of the DRC export ban. But actually, when you put it into the context of the broader history of cobalt, actually the key price hikes that we've seen throughout the past 20 years have primarily actually been on the demand side, or demand-driven, or they've been through issues in the DRC. So you can see one back in, 2008, I think. We had the conflict there. We had Apple announcing the iPhone, government crackdown on artisanal mining, and then the global economic recovery, again, point 2. The last big spike, which you can see there was point 3, we saw the Tesla Model 3 coming out. This was when we started to see that huge growth in EVs. And actually, when you compare the spike that we've seen this year to that, it's actually not as significant in the broader term. So I think what we're seeing now is a step change in pricing, but it's at a level that is sustainable for the market. And now more than ever, amid all these risks from the market, from geopolitics, market participants need to hedge their risk. And that's one of the reasons why we have recently partnered with the Intercontinental Exchange to launch lithium and cobalt futures contracts. On the cobalt side in particular, this is a hydroxide future, so it is a way that market participants who are exposed to hydroxide specifically can hedge their risk without the basis risk associated with hedging with metal pricing, or metal futures pricing, excuse me. This is the first battery metals futures that the ICE has done. It's primarily focused on oil and gas historically. And I think this is the best indication yet that Benchmark is cementing ourselves here in this battery industry. We're really, unlike legacy PRAs, we're really focused on this energy transition vertical. And I think this is a great example of the hard work that our pricing team has done recently. And it now, as well, of course, offers a way for those players that do use our pricing to hedge their risk adequately. So this is my final slide. I'm going to leave with a few words for the year ahead. I think one key trend that we're going to see over the next maybe 5 to 10 years is going to be a pivot from most growth coming from the DRC to most growth coming now from Indonesia. The huge ramp-up that we saw at KFM, for example, that's now primarily happened, right? We don't really see any significant new greenfield investment in the DRC. There are some brownfield expansions there, but nothing really greenfield. And so really it's Indonesia that we now see as being the key growth driver in terms of mine supply. Talking more broadly about the next few years, shrinking surpluses is something that we now anticipate. So as I said, we were in huge oversupply last year. This year, even with the DRC export ban, we expect the market to remain in surplus. But as demand grows, those surpluses are going to shrink. And that, in turn, is going to allow prices to recover and rise up to higher levels. In terms of demand, there are a number of tailwinds and also some headwinds. We see EV demand growth remaining extremely robust. We see strong growth in the Chinese market, but also in the European and the North American markets. On the headwind side, we saw, I think yesterday, that the Trump administration is actually now looking to, or hoping to remove some of the tax credits associated with that, and so there is a potential risk there. However, I would point to the European market, where we've seen several subsidies ended at the end of at some point last year, and we still saw EV growth there. So I think just because subsidies are going away, it doesn't mean that there is going to be a drop in EV sales. It might mean a slowdown in growth, but there will still be growth. On the technology side, China's banned the export of intellectual property for lithium ferrophosphate batteries. And I think what that means is that it further cements LFP as a China-centric technology, and one where we don't really anticipate significant production of LFP batteries outside of China, except in some places, for example, like Morocco, where you have Chinese companies that are really going to invest there. So when Europe and the United States are looking to onshore their value chains, what that means is they're going to be looking at NCM rather than LFP. And perhaps on a different note, geopolitical and military tensions are not going away. We are now no longer in a unipolar world. We are increasingly seeing geopolitics becoming, or critical minerals becoming important for the US, for China, and Cobalt will remain at the forefront of those thoughts moving forwards. That's it from me. Thank you very much.
Thank you. Thank you very much, Will. Very interesting report, another year of records. And before we dive into the details, I really want to take a step back. And we've been working on this report for 3 years now, and a lot of things have changed. So what were the key trends on the market in the last 3 years that actually brought us to where the market is now?
I mean, I think on the supply side, one of those key trends has been this increasing influence of China in the DRC and elsewhere. We've seen huge ramp-ups in production and capacity from Chinese assets, not only CMOC in the DRC, but also the Chinese-backed H-Powers in Indonesia. I'd say that's really a key trend. And perhaps more recently, we started to see Western countries starting to become more cognizant of that and become more aware that actually there is this idea of security of supply that the US in particular is pushing. Europe, I think, is now realizing that they actually do need access to Chinese minerals, not just cobalt, but across the entire value chain. And I think that kind of broader geopolitical tension or geopolitical risk is something that's really apparent. And I think that is one of the key trends, at least on the supply side. On the demand side, I think the key trend really is EV growth. We've seen really, really strong growth in the past few years. I think some people might have looked 3 or 4 years ago when we had we have double-digit growth now, but really strong double-digit growth, like 30, 40, 50%. And in comparison, people are saying, it's slowed down in recent years. I think that was always going to be the case. That kind of early stage, almost exponential growth was never going to be sustainable. We're now in that kind of middle phase where we see strong, robust growth year on year, and it's sustainable growth. So it's growth that we see is going to again continue into the next decade and beyond.
And that's what the figures in the report show. 2024 has been another year of records. There was demand exceeded 200 kilotons for the first time. Supply reached absolute new heights. Secondary cobalt supply increased as well, and cobalt prices saw further decline. Personally, what was your main key takeaway from last year, and why?
I think last year showed that the importance of cobalt to these battery supply chains cannot be understated. And I think even though you saw that drop in prices, yes, some producers cut output, yes, some miners, 2 or 3 actually went offline. But actually, because of its byproduct nature, the cobalt supply chain in a way is almost more robust than a primary mineral, right? So I think it shows that there is that robustness in supply as well as in demand. I think as well the increasing ESG stuff both on the supply and the demand side actually is really relevant. I mean, that figure of well over 70%, and I think that's not including Glencore because that happened this year.
Yeah.
I think that just goes to show how vital that sustainability credentials are, not just to people that are producing these materials, but also to end-use consumers. As I said, the Western automakers in particular are really keen on that, and I think it's now, it's not optional, right? It's a really key part the market.
Yeah, absolutely. I'd like to focus on the export ban, which has very much been the talk of the cocktail yesterday, and I'm sure it will continue conversations today. It's the first major policy intervention by the DRC in the cobalt market that, as we've seen on the slides, that resulted in immediate price support. And as we've been discussing, everyone's expecting the next steps to be announced very soon. I wonder if you could share what's your assessment of the ban. So we saw the scenarios, that's very much looking forward. But what impact has it had on the market so far? And do you think it achieved its objectives?
I mean, clearly it seems the primary objective of that ban is the DRC looked at the price environment last year and decided they needed to do something to boost revenue, right? And if you look at the impact we've seen on pricing, clearly that has increased cobalt prices. Now, obviously, if you're not able to export the cobalt, you're not able to sell it, right? So I think the next step is kind of how do you support that price and support that revenue without either opening the floodgates and tanking the price, or conversely kind of going too far the other way and potentially leading to demand destruction. So it's not a very easy job, I don't think. In terms of where the market stands now, I mean, global cobalt stocks were, well over 100 KT, I think, at the end of last year, not including Chinese government stockpiling of refined metal. So, there's significant tonnage of hydroxide sitting, at port in Malaysia, in Durban, in China. So, there is available tonnage of material. There were some issues immediately after the ban, just because of supply chain issues. Some material was on the road or it was on the water. There was obviously a lot of speculation at the beginning. We saw some traders with short positions being literally caught short, and that I think led to some of that initial volatility. And I think volatility is kind of the key trend that we're expecting as well, right? These kind of shocks, if you like, on the supply side, they do engender this volatile price environment. And again, that's another reason why we've launched these futures contracts to enable market participants to hedge that risk that you get from that price volatility.
And that's getting very, very much attention. We'll talk about the futures contract in just a second. I wanted to focus on another finding of the report, which is about artisanal cobalt mining in the DRC. You say in the report that it reached a historic low of 2% of the DRC production last year. Why has it dropped?
Yeah, I mean, I think if you look at cobalt as being, in some ways, it's price inelastic from a supply point of view because of the byproduct nature. Artisanal mining is the most elastic part of the cobalt market. These guys, they are the swing producer. And I think as prices began to go down, we saw artisanal mining drop. That doesn't mean that there are no artisanal miners. It probably means they've pivoted to perhaps other metals. But in terms of cobalt, that share, and in fact the actual tonnage, right, has dropped to historic lows. So it's not just as a percentage, it's hit the bottom. Also in actual tonnage terms, that figure is, we think, bottomed out. And moving forwards with the EGC and the other attempts at formalization from the DRC, we don't really expect that market share in percentage terms to grow significantly. Yes, there might be some kind of absolute growth if prices go up, but I think as a percentage of total supply, we're really at a bottom now, and it's going to stay that way.
I'd perhaps just add to this and putting this figure in perspective that in the region for many it's still the only viable job opportunity in there, and the challenge isn't really to eliminate artisanal mining but also to make it fair and safe and free from any human rights issues. That I think is
exactly
totally. Just last question before we move on to the panel. You had a slide on the benchmarks partnership with the Intercontinental Exchange. I want, what does it mean for the industry in general, if you could just say a few words about this?
Yeah, I mean, I think this is our first futures contract for both cobalt and lithium. This is the Intercontinental Exchange's first futures contract on battery metals of any kind. And I think, at least from the cobalt point of view, this is, a real way for market participants that do use our pricing, our spot pricing, to adequately hedge that risk. And I think this is something that I've kind of drilled into a bit through the presentation, right, is that, you know, these price changes, the volatility in price, the supply side shocks, all of that contributes to risk. And the fact that we now are able to offer a futures contract for hydroxide, A, it eliminates the basis risk of using a metal future if you're a hydroxide producer, and B, it allows those companies that are using our price to adequately hedge. And I think, you know, even putting it into the broader context of project financing, right? I mean, if you look at potential Western investment in Cobalt, I mean, this is futures more broadly, rather than just our own. You know, one of the reasons that China has been able to go into the DRC, into Indonesia, and build these sites is, I think they're more happy with risk than the private sector in the West. And I think the more, you know, liquidity that we start to get on these hedging mechanisms, that will be able to help those the Western debt markets in particular to you know, provide some assurances and some risk mitigation, and hopefully that will allow them to get more involved into these supply chains.
Yeah. Thank you. I think this provides us with a very good segue to the other segment of our panel.